I think when we had, see, post the global financial crisis, circa 2007, 2008, so December 2007 to March of '09, we had a lot of inflation on Wall Street because the
Yeah.
Fed bought all the bad assets from banks, primarily mortgages, and that drove down interest rates. And of course, stocks went up and even home prices started to rise again, but didn't really hit Main Street that much. And the reason is that the deficit started to fall dramatically. The next time we have a recession, my prediction is that deficits will be around $5 trillion per annum, and that means they're already at two. 1.2 is just interest payments.
MichaelPento has been vocal about the contradictions in the current U.S. economic narrative. According to him, many of the economists on the Federal Open Market Committee are sounding alarms about a recession, yet asset prices remain near all-time highs, credit spreads are tight, and financial conditions are remarkably easy. This disconnect, he warns, could create dangerous blind spots for investors who are unprepared. If your portfolio lacks inflation protection, Pento cautions, you could face serious losses once interest rates are cut and the dollar begins to lose value against hard assets like gold, platinum, and energy. While the dollar may remain relatively stable against other fiat currencies, it is virtually guaranteed to decline in purchasing power when measured against tangible assets. The mechanisms by which the Federal Reserve intervenes are central to Pento's concerns. Rather than directly declaring interest rate cuts, the Fed injects liquidity into the banking system through primary dealers, driving down interbank lending rates. But when long-term rates threaten economic stability, the Fed has gone further, buying long-term treasuries, corporate bonds, mortgage-backed securities, and even junk bonds to prevent asset prices from collapsing. Pento points to the 2007 and 2008 financial crisis as a precedent, when the Fed's purchases rescued banks and propped up Wall Street. This intervention, while stabilizing financial markets, often bypassed Main Street, leaving ordinary Americans with little to no benefit from these actions. Pento highlights the looming scale of fiscal imbalance as another catalyst for inflation and gold appreciation. Unlike the 2008 crisis, current deficits are already astronomical, hovering around $5 trillion annually, with interest payments alone consuming a significant portion of federal revenue. A recession would likely double these deficits, flooding the economy with money that does not just circulate on Wall Street, but reaches the general population. This helicopter money effect, combined with easy credit and central bank intervention, creates fertile conditions for gold and other precious metals to surge, acting as a hedge against the inevitable erosion of purchasing power. Now, we present the clips from Pento's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates, and enjoy the video.
Well, what they do is they print more money, they shove it into the banking system with the primary dealers, and that supposedly is supposed to drag down the borrowing cost, the overnight interbank lending rate. That's how they get
Right.
it down. But when the Fed really went off the reservation is they went and said, well, let me see. I don't want to have a recession anymore, and I can't allow long-term rates to rise. So I think I'll just buy long-term treasuries, and I think I'll even buy corporate bonds. I'll even buy junk bonds if I have to. I'll even buy mortgage-backed securities to make sure home prices don't fall. And I rescue and I save banks' balance sheets. That's what they really do. The, the,
Mhm.
the Federal Reserve is in position to rescue banks. And if banks' assets, which are mortgage loans and corporate bonds and government bonds, they'll buy them all. They'll take them off their balance sheet. I think when we had, see, post the global financial crisis, circa 2007, 2008, we had a lot of inflation on Wall Street because the
Yeah.
Fed bought all the bad assets from banks, primarily mortgages, and that drove down interest rates. And of course, stocks went up and even home prices started to rise again, but didn't really hit Main Street that much. And the reason is that the deficit started to fall dramatically. The next time we have a recession, my prediction is that deficits will be around $5 trillion per annum. And that means they're already at two. 1.2 is just interest payments. So if we have a recession now, and recessions usually jump the deficit by 200%. So you might see, $5 trillion in deficits, 4 to 5 trillion easily. And that means that the money is going to not stay circle around the canyons of Wall Street. It's going to go right to the people again. It's going to be another form of helicopter money. Now, I'm not even saying they're not going to actually engage in another round of helicopter money. Who knows with these people? We're dealing with maniacs here who will do anything they can to prevent a depression because that's how crazy things have gone. See, if asset prices were just a little bit out of whack and there wasn't a lot of leverage in the system, you could have a recession, a mild recession, and reconcile those imbalances. But as we saw in April 2nd, when Trump just said, we're having these Liberation Day tariffs, and that caused immediate chaos, complete chaos in the credit markets. And long-term yields began to spike, and the stock market dropped 15% in a few trading days. So if you want to let reality reign, you're talking about a 50% plus drop in those asset prices that banks hold. So banks would be going out of business left and right. And so we can't have it anymore. We have to do this. We're going to monetize trillions of dollars and probably new debt just because of the automatic stabilizers that they kick in. And then we might have another round of stimmy checks. I
Right.
mean, it's real. I'm laughing, and I shouldn't be. Yeah, I'm actually pissed off. I'm really, because I own how. I mean, I'm thank God I'm very wealthy, and but I worry about the middle class has been eviscerated, Andy. I mean, this is an institution that's supposed to be protecting these people, but they can't even afford a house anymore. And you look at if you look at quintiles, it's really only the top 20%, the top quintile that's really holding this economy together because of the bubbles and the asset prices. But look at the bottom four quintiles, especially as you get towards the first, second, and third. Say the bottom 60%, they have nothing. They live paycheck to paycheck with just a few $1,000s in the bank. It's a shame. You can't have a viable, healthy nation with such a bifurcation of living standards.
No, I couldn't agree with you more, and I see it. I see it in my own local community, and also with and these people are professional. They do well, relatively speaking. It's all relative, but at the end of the month, they don't do relatively well, if you would.
No, it's trailer parks so in Naples is a gorgeous community. It's like you have country clubs and trailer parks and renters. I mean, it's just like that's how it is. That's the country's becoming the trailer parks and country clubs. Shouldn't be that way. If we had a manufacturing base, and I give Trump a lot of credit for this, when he started, he said, "Let me rebuild the middle class. Let me rebuild the manufacturing base. Let me stop sending pieces of paper overseas so that China owns all of our treasury debt
Mhm.
and Japan owns all." I mean, I admire that. It didn't hit him. It didn't occur to him the damage that needs to be done to get to that place. I mean, if you're gonna increase tariffs and onshore manufacturing here, you're gonna have to raise tariffs by 100% or more, and the economy just can't handle it. The U.S. economy can't handle it because it's just a highly over leveraged, financialized economy. Just cannot handle higher interest rates. Can't.
Do you think this is by design, if you would? And I get it that that sounds conspiratorial.
I don't think it. So not that I haven't thought about this. I could be wrong, Andy. I don't think it's nefarious. And how you define nefarious means evil. I think it's more arrogance and hubris. It's about power. So maybe it's a little bit of a nefariety there. So people in charge thought, hey, we have a printing press. I want to maintain power. The way to do that is to give the people bread and circuses. This has been going on since Rome. So maybe that's the evil there. It's like, I need to maintain power. I need to run massive deficits. I need to make the people happy to keep my positioning.
The social consequences of the current financial system are becoming increasingly apparent, and MichaelPento has consistently highlighted this growing divide. In the US, the top quintile continues to reap the benefits of asset inflation, enjoying soaring stock prices, rising real estate values, and the perks of easy credit. Meanwhile, the bottom 60% of Americans are left struggling to make ends meet, living paycheck to paycheck, often with minimal savings or financial security. Housing affordability is collapsing, leaving the middle class squeezed from both ends, while the wealthiest continue to accumulate assets at unprecedented rates. This widening inequality underscores why hard assets like gold are no longer just optional investments, they are essential refugees. In a system distorted by central bank policies, massive deficits, and artificially suppressed interest rates, Gold offers a stable store of value, preserving wealth even as fiat currency loses purchasing power. For Pento, the answer lies not in temporary market interventions, but in deep structural reforms grounded in sound monetary principles. He advocates for a system in which money supply growth is tied to GDP, ideally reflecting the natural increase in gold production of roughly 2% annually. Such an approach would prevent arbitrary expansion of money and reduce the risk of inflation spirals, while simultaneously strengthening the dollar. By restricting the fractional reserve system and aligning currency with tangible assets like gold, the economy could achieve stability and a sustainable financial framework. While this perspective may seem radical in a world accustomed to central bank interventions and quantitative easing, it embodies the Austrian school principles that Pento has long championed: discipline, measured growth, and a recognition that economic stability cannot be manufactured with endless artificial injections of liquidity.
I think it's two. Well, it's like you can't separate the two. Yes, of course, it's central bank buying. So I think it's two reasons. Number one is what happened with these tariffs, and even before that, with confiscations and of whatnot of our creditor nations. So think about if I'm a foreign nation, China, Russia, India, whatever, and my trade surplus is going into US dollars and into the treasury market. And then the US says, I don't like what you did. I'm going to impose sanctions on you and then confiscate your assets. That kind of thought process was going through a lot of foreign nations, creditor nations. And they said, you know what, I'm not gonna do that anymore. I'm going to, instead of taking my dollars and buying treasuries and have them sit with you, I'm going to sell my dollars and buy gold.
Mm-hmm.
That's one leg of it. That's a big leg of it. And the other leg of it is, I think even domestically, people understand where we're going. They're starting to understand that negative real interest rates is what we're going to have again, and it's going to be there forever. It's going to have a very protracted existence of negative real interest rates and deficits. Debt and deficits are through the roof, and the only way you can get around them is to try to monetize. And I don't think it's going to be successful, but to try to monetize them away. So it's just an eschewing the dollar and U.S. debt, both domestically and globally, and into. I mean, I own gold for a very long time. I also have recently, over the last several months, have jumped on platinum. I think that's going a lot higher too. Platinum used to be a lot more expensive than gold. It's more durable and more rare than gold. So I don't know why it would be a lot less than gold. And that's not saying that gold is going to come down. I think platinum is going to go a lot higher. I also recently, and I mean very recently, as in today. So I bought some energy, pure energy today, but I've been long land that produces energy for even a longer time. Now I'm just buying the company. So I think that's the one asset I can find that has a very nice yield, because yields in money markets are going down dramatically in the next year. So not I didn't say long-term rates, because that's one of the reasons why I think the bubble could burst. That'll be one of the caveat. That's one of the catalysts that will pop the bubble. But I do like land producing energy assets.
I'm glad you
The
said
short end
that.
of the yield curve, sorry.
Mm-hmm.
Just because I had a virus, and he was actually buying, this is the most disgusting thing about it, I think it's just depraved, buying mortgage-backed securities up until March of 2022. After home prices were up 20% year over year. I mean, it was multiple years of 20% home price increase. And he still thought it was a good idea to buy mortgage-backed securities. So he blew up his balance sheet. The balance sheet went from $4.5 trillion to over $9 trillion. What's the Fed's balance sheet? That's the money they create by fiat, the credit, and they buy stuff with it. They buy mortgage bonds and treasuries. And the banking system's full of liquidity. What do? Go out and they buy more of the same stuff. And interest rates go to zero, and asset prices, are a discount to earnings. So if the interest rate is basically zero, then you could just make home equity prices and home prices infinite.
Right.
So this is what we're dealing with. And Powell said recently that he's ready to go now. He's convinced, looking at the figures from the non-farm payroll, the Bureau of Labor Statistics, which is a division of the Labor Department, the non-farm payroll report. He is now convinced now he's going to start slashing interest rates. So I think it could be 50. He could start with 50 on September 17th is when I think the meeting is. That's when the meeting announcement is. And I think it could be 50. And then we're going to go on from there. Maybe one more cut before the end of the year. So I'm looking at maybe 75 basis points in cuts, and then more in 2026. And then we get, Andy, we get the replacement of Jerome Powell,
which will be friendly.
So
to the
who's
administration.
who's gonna be very administration friendly? Who's gonna even wreck the dollar at a faster pace? So I mean, here's the thing: inflation has. I mean, they say they have an inflation target. Well, first of all, let's just say in 1913, the Federal Reserve put into existence, chartered by the Congress, and it was for stable prices. Stable prices. Now, I think stable prices would be an inflation rate of 0, right? That was redefined after the Bernanke Fed. It's 2%, universally adopted by all central banks, that cabal of counterfeiters. So now it's 2%. So what I find very disturbing is that the inflation rate has been above 2% for 51 months in a row. So I mean, if you have a target of 2% and you miss your target, you're above that target for 51 months. Andy, what would your reaction be? Would you say you're going to start cutting interest rates now, or would it be like, hey, at the very least, we should be keeping them where they are, but maybe even increasing the Fed funds rate because we're missing our target. The year-over-year target has been missed for 51 months in a row. But yet, because of this horrific numbers we're getting from the Labor Department, and then the misread, because they're Phillips curve labor market economists that inhabit the Federal Open Market Committee. They're now saying, well, we're in a recession now. We're in this deep recession. Never mind the fact that asset prices are at a record high, that credit spreads are very tight, financial conditions are very easy. We're in a recession.
Right.
And we're going to slash interest rates. So that's what we're going to do. So if you don't have any inflation protection on your portfolio, you're going to regret it.
The recent surge in gold and silver prices reflects the culmination of these structural pressures and market dynamics. Central banks continue to buy precious metals, inflationary forces intensify, and retail investors, finally waking to the fragility of the global financial system, seek tangible stores of value. Pento views this as a rational response to decades of fiscal mismanagement, hubris, and over-leveraging in global markets. Hard assets like gold cannot be printed or manipulated, offering both a hedge against currency devaluation and a sanctuary during economic uncertainty. For informed investors, gold is far more than a commodity. It represents a lifeboat amid the storm of artificial liquidity, rising debt, and systemic instability, providing protection for wealth in a world where traditional financial safety nets are increasingly unreliable. How do you anticipate the price trends of gold and silver evolving in the near term? Share your thoughts on experts' analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. Thanks for watching.